One, this is Rob Hoxton. I'm CEO of HFI Wealth Management. We're glad you're with us today. This will be the first of our quarterly webinars for the year. Amanda Runkles, who's Director of Financial Planning and a Senior Wealth Manager here at HFI, will be leading us through her presentation, Common Misconceptions About Retirement. I think it's a great presentation you'll get a lot out of. If I were to guess, you may have questions. And while we're not smart enough to master the technology to be able to take those questions live, we'll provide you with the contact information so you can call or email us with specific questions about your situation. Amanda joined us 3 years ago. She's a CPA, a certified financial planner, and again, the Director of Financial Planning here at HFI. And without further ado, I'm going to hand the headset to Amanda and let her start the presentation.
Hi, thank you, Rob, for that introduction, and thank you to each of you for joining me today as we start our webinar series. And today we're going to talk about common misconceptions about retirement. My thought process and inspiration when I put this webinar together and was determining what the content would be centered around a lot of questions that our clients and our prospective clients ask on a regular basis. And so we're going to talk about the 5 areas that, again, I'm most commonly asked. We're going to touch upon these subjects at a high level, and you may have a situation that's unique and different than what I discussed today. And as Rob mentioned, I welcome questions. So at the end of the webinar, if you have questions, you'll see my contact information through email or through telephone. Please don't hesitate to call or email with those. And before I start the presentation, I just want to point out that here at HFI, we are fee-only financial planners, which means we don't sell any products. So all of the recommendations and the analysis that I've prepared for you today is presented in a way that has no financial gain to us. And that's important to understand because I'm going to talk about insurance and estate planning and cash flow planning and specifically talk about annuities. And so it's important for you to know that I have nothing financially to gain from those recommendations. So without further ado, let's jump into the first topic in Social Security. So the first question I'm often asked is, when should I start drawing Social Security? There are 3 common ages at which time people generally apply for Social Security. Now, you can file any time from age 62 to age 70 at any given year, any given month, but these are the 3 main ages that people apply. You'll see there in the middle that full retirement age is anywhere from age 66 to 67. Your full retirement age will be dependent on your birthday. So to find your full retirement age, you should go to the Social Security's website, and that's www.ssa.gov. You can put in your birthday, the year you were born, and it will determine what your exact retirement age is down to the month. So you can see that if you retire at full retirement age, or if that's when you start drawing benefits, you get 100% of your benefit. Now, if you start taking it early, you get a reduction to that 100% benefit. And you can see if you file early all the way up until 62, you'll see a 25 to 30% reduction in your annual benefits. Now, the important thing to remember here is that that's a permanent reduction. Once you file and start taking it, you cannot change it. So that's a really important consideration. Now, the exact opposite of that is to wait until you're age 70 or delaying your benefits. And for each year you delay past full retirement age, you get an 8% annual increase. So you can see there that you'll see a 24 to 32% increase in your annual benefit. And again, that's permanent. So once you file, that can't be changed. So what does this mean from a number standpoint? I put this example together. These are fictitious people, but they both have their own earnings record, and they're age 62 now. So let's look at what their annual benefit would be at any of the given ages that we just discussed. In this situation, at age 62, their annual benefit would be $33,000, a little more than that. If they waited until full retirement age, their benefit would be $44,000. And if they waited until age 70, their benefit would be a little over $58,000. So that's a huge increase between age 62 and age 70. And if you did the math, that's a 75% increase over an 8-year period. That's huge. The numbers don't lie, the math doesn't lie. Claiming Social Security is really a play on life expectancy. And what we do here at HFI is we put together an individualized, personalized strategy for you. So if that's something that you're interested in, all we need is some basic information. We need your Social Security statements, and we need to sit down and have a conversation. But that's something I really enjoy doing for our clients and putting that together and showing them how the math works and putting together a detailed strategy for you. Now, there's some other considerations that you should think about before you start drawing. And I want to back up for a second and talk a little bit about how your benefit eligibility is determined. You can actually claim benefits in one of two ways. You can claim it based on your own earnings record or your earnings record of your spouse. So you can take your own record or 50% of your spouse's benefit, whichever is greater. So when you're determining whether or not to file, you need to consider whether your spouse will take their own benefit or 50% of yours. If you draw early at 62, you're then decreasing the amount that your spouse will get because they can only take 50% of what you were taking. Something to consider. Additionally, survivor's benefits are really important to consider. You have, again, if you were to pass away later in life, your surviving spouse can start taking what benefit you were taking before you passed away. So if you delayed benefits and waited until you were 70, then you passed away, unfortunately, at 75, your surviving spouse has a higher income every year for the rest of his or her life because you delayed your benefit. So it's really important to consider your spouse. Your strategy should be that of a couple strategy. You should take into consideration your life expectancy, health concerns, different things like that instead of just filing as early as possible. And hey, if that works out and if that's what you want to do, but here at HFI, again, we like to provide our clients with the mathematically best strategy for you as a couple. Disability benefits I want to touch on briefly. This is something I've seen a few times recently, and I really find it interesting. Disability benefits are something that you get every year from now until the end of your life. Now, what happens in the background that people aren't aware of is that when you reach full retirement age, the Social Security Administration switches that from a disability benefit to a retirement benefit. Now, that's done on the back end, and you won't ever know any different because you'll continue to get your check. But what that means is that because it's now a retirement benefit, you can actually pause it or turn it off. I think the technical term is called suspending it, and then allow yourself to get that 8% annual increase in benefit until you're 70 years old. It's a little-known strategy, one of many strategies that isn't discussed in the media, but that is available for you to do. So here's a few other questions that I get on a regular basis that I wanted to address. A couple other misconceptions. The first is that what's on my Social Security statement is an accurate reflection of what I expect to receive. That's actually not true. I'll first point out that they don't mail statements anymore. You actually have to go online and request them. You go to the Social Security website, set up a username and password, answer some questions about yourself, and then you have access to your statement at any given time. How they calculate those numbers, and again, that's a cookie-cutter report that they provide to everybody in the country. So they can't take your personal circumstances into consideration when they calculate that number, especially if you're a federal employee and you expect to receive a federal pension under the CSRS program. Your Social Security benefits will be reduced based on that CSRS pension, and that's not reflected in that statement. So you have to do some math behind the scenes, and we can help you with that because your benefit will be a lot different than what's on that statement. Additionally, the way they calculate those numbers on your statement is to assume that you will continue to work until that age and you'll continue to earn the same amount of money that you're earning now. So if you look at your statement again and it gives you an estimate for your age 70 benefit, what they're assuming is that you continue to work until you're 70 and you're earning the same amount of money. So if you actually retire at 60, you have 10 years that you're not putting money into the Social Security system, and therefore your benefit is going to be less than what that statement shows. So just a couple things to keep in mind. Also, the second item on this slide is that I didn't have any earned income and I'm now divorced. I won't have any Social Security benefit. Again, as we just discussed, just because you don't have an earned income and an earnings history, you're actually eligible for your ex-spouse's benefit, 50% of your ex-spouse's benefit, as long as you were married for at least 10 years. So that's another consideration. We're going to move on to our next topic, which is taxes. The common question that I get, my taxes will go down during retirement, right? Well, generally, yes, but there's a few other things to consider. I've listed here a few common income sources that retirees receive. The first is pension income and distributions from traditional IRAs are 100% taxable as ordinary income. You probably mostly already know that, but if you expect to receive a pension, if you are a federal employee or you work for a large company, and your pension will mirror closely what your earned income was, you're going to be in a very similar, if not the same tax bracket as you were when you were working. So your income isn't, your taxes won't necessarily go down. Also, your Social Security benefits may be partially taxable. So the taxation of your Social Security benefits depends on your other income sources. And the calculation is different depending on whether you're married or whether you are filing individually. But let's take a joint married filer, for example. If your income is between $32,000 to $44,000, so your income from other sources like dividends, pension, maybe part-time earnings, etc., then 50% of your Social Security benefits are taxable. And if your income from other sources exceeds $44,000, then 85% of your Social Security benefits will be taxable. So it differs per person. It differs based on your income sources, but you need to consider that part of that benefit will be taxable, and you may want to withhold taxes on that so that you're not hit with a large tax bill at the end of each year. The third item on this list refers to annuity distributions. We're going to talk more about annuities towards the end of the presentation. But annuities are taxed in one of two ways. They're either fully taxable if they're wrapped within an IRA. If your IRA is held in an annuity, it's going to be 100% ordinary income. Versus what's called a non-qualified annuity. And that's basically where you took a lump sum of money and you purchased this annuity. Or you made monthly payments to purchase this annuity. So you have a cost basis in that. So when you start taking distributions, part of your distribution will be considered a return of your cost and not taxable. But the portion that's allocated to earnings will be fully taxable as ordinary income. So again, I think there's misconceptions about annuity products, but annuities are tax deferred, not tax exempt. So when you start getting the income, they will be taxable as ordinary income, and they're subject to that 3.8% Affordable Care Act surtax. Now your income has to be pretty high before that tax kicks in, but it is a consideration if you expect a larger income. The fourth bullet point here is rental property income. Again, a common source of income in retirement. You have these rental properties you've owned for quite some time, and the problem with that is that depreciation expense is reduced over time. So as you hold these properties later in life, you have less depreciation expense to offset the income, and therefore you have more income subject to taxation. This income is also subject to that 3.8% surtax through the Affordable Care Act. Now let's talk about some deductions that may decrease during retirement as well. You have your dependents, they've moved out, your kids have moved out and they're on their own, which you know you guys are really happy about. You don't have to support them anymore, but what that does is it reduces the number of exemptions that you're allowed to take on your return. So reducing your exemptions may increase your taxable income. A few common expenses that may also reduce during retirement are related to interest expense. So at this point in your life, you're approaching your mortgage being paid off, or your mortgage may be paid off, and so you don't have as much interest expense to deduct on your tax return. Or in retirement, you're on this fixed income, and one of the first ways retirees generally fix their expenses is to reduce the amount that they give to charities. So if you're not giving as much away to charities, you don't have that to deduct on your tax return either. So any of those situations could cause your taxable income to increase. So I always recommend that clients, if any of these situations sound unique to you, that you contact your CPA or your accountant and make sure you've accounted for that properly. You don't want any tax bills, large tax bills, to surprise you during retirement. So let's go on to question number 3. The value of my estate doesn't exceed the federal exemption. Why would I need estate planning? Well, there's a few different things to consider here. Over the past 3 or 4 or 5 years, what we've seen is a significant change in the way the estate taxation laws are written. The exemption was constantly changing. The federal exemption was constantly changing, and now it's set to index for inflation. We know that going forward, it's going to increase for inflation every year. But your estate documents might have been written under the old laws, so it's worth revisiting. It's worth taking a second look to make sure that these wills and trusts are set up to take advantage of the way the laws are currently written. Additionally, some states have what's called estate taxation. I know that's a little difficult to say. They have state estate taxation, and those limits are well below the federal exemption. So let's just say the federal exemption is $5.3 million. Some states may have an exemption limitation of $1 million. So you may be chugging along in retirement and thinking that all is great, you're not going to have a tax bill, and then you pass away and your heirs realize that there's this state estate taxation, and now they owe money on it. Well, there could have been planning done to avoid some of that unknown taxation if there could have been proper planning in place. So something to consider based on what your state tax laws are. The second thing here is to double check beneficiary designations. This is really, really important. Let's say you've gone to your estate planning attorney and you have this plan in place, and you think all is going to flow through. You have a trust set up to catch your assets when you pass away, and all is fine and dandy. Well, let's say you'd never communicated those plans to your investment advisor, and your beneficiary designations on your account are straight out to your children. Your beneficiary designations supersede what your will says. So if you pass away without having that trust as the beneficiary of your account, the money will outright go to your children, and they won't flow through that money won't flow through that trust. So you need to make sure that all of that is set up and working as you designed it to. And it's really important to communicate your estate planning with your investment advisor. One other additional consideration for estate planning is to make sure that your current power of attorney and your medical directives are in place and working properly. We don't want to think about getting older and having health issues. Unfortunately, it's a fact of life. And so you want to make sure that your wishes are documented, that the people that you put into power understand that they're put into power, and that they understand your wishes are in place correctly. Okay, so let's move on to question number 4. What insurance coverage do I need? So this is going to be different for those approaching retirement versus those in retirement right now. And we're going to talk about the 3 major insurance types, so life, disability, and long-term care. Let's look at life insurance needs for those approaching retirement. Again, you need to double check that your proceeds would pay off your liabilities if necessary. They'd account for living expenses for your family. And this is the big one. They need to make up for lost retirement savings. Let's use the example of someone that's 5 years from retirement and fully funding their 401k. So they're putting in $52,000 a year into their 401k. Well, they pass away 5 years before retirement. Now there's 5 years that's not being funded into your retirement account. That's $260,000 that's not being put away for retirement. So that could potentially affect the way your surviving spouse or children live over the next 20 or 30 years, because they have $250,000 less to live off of. So it's really important to address that. Disability insurance, kind of along the same lines, you want to make sure that your benefits would cover your living expenses so you don't need to draw down on your savings. And you want to make sure you continue saving for retirement. So let's take the same situation. You're 5 years out from retirement, you become disabled. Now you're entering retirement with $260,000 less than what you would have, and you have health care costs on top of that. So it's a really big risk to address properly and something to consider before retirement. The last insurance that I want to address here is long-term care. This is really important to consider as early as possible before retirement. I think people have a pretty large misconception of Medicare's role in the long-term care field. So Medicare is not designed to cover those costs on a long-term basis. What they do cover for the first 20 days you're in a long-term care facility, they pay 100%. Anything over day 21, so day 21 through day 100, you split the cost. It's not 50-50, but you pay a piece and Medicare pays a piece. And then anything over 100 days is 100% your responsibility. So if you're there for more than 3 months, you've got 100% of the cost that you have to pay, and the costs are astronomical. I'm going to show you some of those costs a few slides from this, and we're going to look at that a little closely. Also, long-term care insurance, long-term care costs are a high-risk area for healthy retirees, and why is that? So let's look at healthy retirees and unhealthy retirees and assume two different buckets here. I don't mean to be a little morbid, but unfortunately have to be when you talk about these things. Unhealthy retirees may pass away early into retirement from things like heart attacks or other illnesses. They're not going to live long enough to need long-term care. So if you're healthy and you think, oh, you know, I don't really have many medical costs, I don't really need to consider that, the chances that you'll have a longer lifespan are higher, thus increasing the potential that you'll need long-term care facility. So again, something to consider, and I'm going to show you some costs. Let's backtrack for a second. If you're already retired, life insurance may not be necessary if your retirement is fully funded and your liabilities are paid off. However, you may want to maintain enough benefit to pay any estate taxes. So let's say you know you'll pay estate taxes at your death, but you don't want to liquidate any of your other assets to pay it. You might want to just keep a small policy on hand to pay those taxes at your death. Obviously, disability insurance isn't necessary. Let's look at long-term care a little more closely. Okay, these numbers are a little frightening. So today's average annual nursing home cost in the state of West Virginia is close to $87,000. Now, let's consider a 65-year-old that enters a nursing home 20 years from now, so when they're 85. The cost in 20 years for 1 year is almost $278,000. Now, let's assume you're there for 3 years. Now the cost is pushing cumulatively $885,000. So you can see by looking at these numbers how important it is to have some coverage and plan appropriately for it, especially if you're the first spouse to enter a facility. Imagine the amount of money it would take to pay for your care and then what you'd leave behind for your surviving spouse that's not in a facility yet. You don't want to drain your assets so that the surviving spouse doesn't have much to live on. A few important considerations to consider when buying a long-term care policy. You want to look at the financial rating of the insurance company because ultimately their financial state will be the ones to pay the policy. Also, you want to add an inflation rider so that your benefit increases as time goes on, so that when you are 85, your benefit may look more like $278,000 instead of looking like $87,000. A little tip, premiums may be more affordable if you choose either a longer elimination period or a shorter benefit period. So what does that mean? An elimination period is basically the amount of time you have to wait before your policy starts paying. So if you choose a 90-day elimination period versus a 30-day, you're going to have to wait 3 months basically before the policy starts paying. That will lower the cost of the premiums you put into the policy. And again, a shorter benefit period means how long the policy will pay. So if you want to buy a policy that will pay only for 3 years, that will be less expensive than one that guarantees to pay for 5 or 7 or longer. Okay, we're starting to run short on time here, so I want to touch upon this last question. I'm afraid I'll run out of money. Should I buy an annuity? So this is a question I've actually been getting a lot more recently as people approach retirement. They're really concerned that they're going to run out of money over the long term. Now, before I move to the next slide and talk about these points, I do want to point out that an annuity is not always a bad product to buy. In some situations, it may be appropriate, but I think there's a lot of misconceptions about how annuities work, and so I wanted to address those. Will an annuity give you the insurance that you need that you won't run out of money? Probably, but keep in mind the guarantee of lifetime income is based on the financial stability of the insurance company. So remember, you're buying a guarantee from a company. So if the company goes belly up or goes bankrupt, you're probably not going to be collecting any of your guaranteed income. There's 3 other points to consider, and these aren't really commonly discussed. The first is that a fixed income does not protect against the risk of inflation. So you know that over a 20-plus year time period in retirement, cost of goods will increase. We're in a really low inflationary environment right now, so the cost of goods isn't increasing that quickly. But we're due for higher inflation. Now, when that will hit is anyone's guess, but we know that it's coming eventually. And when that comes, if you're on a fixed income, that means over a 20-year time period, you'll be able to buy less and less and less because things get more and more expensive. So here's an example. A $40 prescription at age 65 will cost $72 when you're age 85. That's almost a double price. The price is almost doubled over a 20-year time period. So that's really, really important to consider when you're thinking about being on a fixed income for the rest of your life. Also, taxes will likely increase using an annuity. We already talked about this a little bit, but I want to talk briefly about taxation in just a regular taxable brokerage account versus taxation in an annuity. Let's say you have $100,000 in a taxable brokerage account. Every year you're going to pay taxes on that, but it's likely going to be at a lower rate because of capital gain and dividend rates are 15 to 20%. So your tax over time will be at a lower rate versus being an annuity. The tax is deferred until you start pulling money out of it, but it's taxed at your ordinary income rate, which could be anything. It could be up to 39%. So that's something to consider. And the third bullet point here is something people really don't consider, and that's that there may not be funds to pass on to your heirs. Consider 2 time periods with an annuity. Generally speaking, there's an accumulation period, and then there's an annuity period. An accumulation period starts the time you buy an annuity until you start drawing a fixed income on it. And that could be any time from 1 day up to 20 years. I mean, it could really vary. Once you make a decision to flip that from the accumulation period and you say, okay, I want to start taking a fixed income from it now, that's when you switch over to the annuities section or the annuity time period. When you make that decision, you have a few things to think about. You can either take your income in a number of different ways, but the 3 biggest ways are based on your life expectancy, based on the life expectancy of you and your spouse, or based on your life expectancy for a time period of no less than 10 years. So if you choose to take the money based on your life expectancy and you pass away 2 years after you start getting an income and you pass away, there's no money left to go to your heirs. The insurance company absorbs the remaining costs that's in the annuity. All that money that you paid in now belongs to the insurance company. If you choose to get it on your life and your spouse's, the income will continue as long as you're both alive. But again, if you happen to pass away together, maybe in a car accident or some other unforeseen circumstance, again, the money stops. The insurance company collects everything else. And the third option is if you get the money based on your life expectancy but no less than a 10-year time period. So let's say you pass away 3 years in. There's another 7-year period that income is paid to your beneficiary, but the income that your beneficiary receives will not be 100% of what you paid into. The insurance company is still going to make money off of that situation. So if one of your goals is to pass money on to your heirs, annuitizing an annuity will likely not accomplish that. So moving on from that, what can I take away from this other than probably being depressed? It's really important to consult with a financial planner before making any of these decisions, applying for Social Security, buying or canceling insurance policies or annuities. Talk to your CPA about any tax changes you can expect through retirement. Meet with your lawyer, talk about your estate planning documents, and communicate those with your investment advisor. And importantly, remember that every situation is unique. You should discuss life-altering decisions with a fee-only financial planner, one that doesn't have a financial interest in the recommendations that they make to you. They're not trying to sell you any products. With all of that, here's my contact information. I really appreciate you tuning in today. I hope you find this relevant and helpful. I'm going to take your questions via email or phone. I look forward to hearing from you, and I'm going to pass this back to Rob.
Thank you, Amanda. That was well done. A lot of great information. And again, if you have questions, please do call or email. In July, Chris Dorsey, the portfolio strategist and investment analyst here at HFI, will give a halftime market report. So keep your eyes peeled for that invitation. We are just delighted that you've joined us. We appreciate the confidence that you place in our firm, and we look forward to seeing you around town soon. All the best.